Cashflow Diary Podcast, episode 98.
Congratulations, you showed up. Give yourself a high five in celebration of your success. Welcome to the Cashflow Diary, where new and experienced investors come to take confident action towards their goals. Your host is a family man, a real estate entrepreneur, investor, coach, and instructor. As a master facilitator of Robert Kiyosaki's Cashflow 101 game, he's inspired many to begin their journey into creating cash flow for themselves and their family. And now, here he is to offer you the tools required to earn the income desired. Your cash flow coach, Jay Massey.
Okay, and welcome yet again to another episode of the Cashflow Diary Podcast. I am your host, Jay Massey, and I'm so glad you're here. Here's why. I'm glad because you're looking for ways to get started, and we're going to do our best to make sure that you have a thorough understanding, especially in this episode, of not only how to get started, how to stay started, how to keep going and making bigger and better things happen. The marketplace changes everywhere you are. And the best thing, in my opinion, about real estate is that no matter where you are, real estate is also there, and therefore you have the opportunity to have a business. Today's guest is definitely going to help you and I understand so many different areas of real estate from various different levels. And what's really, really cool is that after a while, once you get good at this real estate thing, there comes a transition in your life when you decide, you know what, it's time to see how I can pay it forward. And that's exactly what we're going to talk about today. Now, for those of you joining us for the first time, I'm glad that you're here because you have an opportunity, dare I say, a unique opportunity, unique and special. Go over to learninvestingnow.com because when you get over there, name and email is all it's going to take for you to begin to have access to some of the most basic concepts that I believe is you must know in order to get started and stay started in real estate investing. To be able to understand some of the higher level vocabulary words, and most importantly, being able to know what it is that you need to know before you write that first offer, which is sitting there waiting for you at learninvestingnow.com. Now, today's guest, you got to understand, isn't someone who just started real estate yesterday. However, what's exciting about that is that doesn't mean she's lost her excitement for the business. You ever met someone who's like been doing something for 20, 30, 40, 50 years and you're like, oh my God, I hope I don't end up like you when that's all said and done? You won't have that today. And that's exactly one of the things that attracted me to today's guest. When I saw her in person, it was awesome because I was like, wow. Someone's got excitement still and is out there making waves, changing lives, and doing it in a very, very creative way. So today's guest understands many different areas of investing. And that's the key, is that you can't be a one-trick pony. And we're definitely going to talk about that. She does things as far as real estate management services, portfolio analysis, and she's even had the privilege of being able to mentor people in a one-on-one basis as well as in personal financial coaching. What's exciting for me is to understand how other people also view marketplaces, take down markets, look at cash flow, and make things happen. So do me a favor and welcome Miss Christina Suter.
Well, thank you. Thank you. What a delightful introduction. It's fantastic. I love your story about being excited after 25 years of investing. Can I start off with a story?
By all means.
Is that okay? Okay, great. Because I love investing. I've actually got two stories for you. First is whenever I go to a meeting, my husband always teases me because if I hear anybody say anything about real estate, commercial real estate or syndicated deals, whatever, I go to my husband, I'll be right back, honey. I heard real estate, but I'll be right back. He's like, no, you won't. I'm gone for the rest of the night,
right,
talking to that person about their passion about real estate. And I know what you mean about tired. I'm going to steal it for another minute. I know what you mean by being tired. When I was a young investor, I hung out with this guy. We were dance partners. I actually met my husband doing swing dancing.
Nice.
Believe it or not. And this guy was a dance partner back in the days when I was single and doing swing dancing. And he had several pieces of real estate. I think it was about 3 or 4 apartment buildings. And he was chronically complaining about his real estate. And I actually made a decision after listening to him for probably, 3 or 4 months where I went, I knew I was doing single family at the time, and I knew that real estate was going to be a long-term decision for me. And I promised myself I'd never be that way, that I'd never back myself into a real estate investment that wasn't something I actually wanted or enjoyed. And I actually have held to that very carefully and very intentionally. And I help my clients hold to that, because you can get, scars and t-shirts in real estate. It's not always the easiest business, right? I mean, sometimes it takes you down and you're like coming back up, spitting water out and fighting, going, okay, buddy, let me take you on. But in the end result, ultimately, anything I hold on to, anything I invest in a long-term basis is something I'm like, this works for me. It works for me, and it works as far as an investment and cash flow returns. So that's my personal, you happen to touch on my personal philosophy there, that to enjoy real estate year after year after year after year after year, which is, I think, many of our intentions, is to use it through as an important investment vehicle through our whole lives. You want to actually understand how it benefits you and really works for you. I mean, maybe I'm wrong, but what's your opinion?
No, that's exactly where I was coming from. I mean, one of the core concepts that I spend time talking about is what I call investor identity. And when you buy property that's in alignment with your investor identity, and this is something that you purposefully create, then you're good. You got to make sure you're in alignment, the marketplace is in alignment, the team that you hired is in alignment, as well as the deal, and then any investors as well. And when you have alignment, you avoid ailments, and you and I both understand what ailments are, and they do not sound like fun. But I've got to ask this question.
Sure.
I look at today's entrepreneurs. When I see them, I go, wow, they're awesome. And I look at today's entrepreneurs and I think, they're like yesterday's superheroes. They got capes, they got tights, they got superpowers, all these types of things. But every superhero has a beginning, i.e. an origin story. So what I would love to know is, before you were able to invest in over $15 million worth of real estate and 300 doors and all this other stuff, who were you really before you got started?
Oh, let's see. Okay. I got started really early, so I'm going to actually choose a slightly midpoint story, if I might. I actually got started when I was 17, and my mom actually was in very poor health, and my dad had already passed away, and she thought she wasn't going to be able to take care of the homestead anymore, so she actually gave it to me.
Okay.
And I turned around and rented it out to my aunt and uncle, thank God. Just like, oh, thank goodness, it was easy. And they ended up buying it from me on an installment sale.
Okay.
So that was how I officially started in real estate. But how I knew real estate was my thing was I was running a small business, and it was a business that rented space out to conscious-minded or spiritually minded instructors.
Okay.
Right. So all about, win-win and stuff like that. And I was running, it was a very small business. The truth, it was a very small business. But then I was upgrading from single family to my first multi-unit. And so here I am dealing with a couple thousand dollars in my small business that I'm working with, and several hundreds of thousands of dollars in this real estate decision. And I'm like, I'm just as happy and more comfortable dealing with the 100,000 over here than I am in my own small business over here, which was a passion for me as well. The conscious-minded, being or investor, or the win-win, or the good heart. I don't care what you call it, is still a passion for me. But I was really aware that I was really happy in working really happy working my real estate deals. It called to me and it worked for me, and it was part of my nature. And so what was I before? Well, before I was a 17, 18-year-old girl who had no idea what she was up to. And then midway, I discovered my sense of passion for it and really dove into it as an intentional, conscious choice for my life.
Yeah. And what I love about the word you just said is an intentional, conscious choice, because there are so many stories and where people choose the real estate as a solution to a problem, not because they just said, okay, I need to make money. That becomes the, overarching, I just need to make money, and real estate is where money is. So let me do that. But by making an intentional, conscious choice, you're making a completely different decision than what most people are making. What led you to the ability to say that, to make that intentional, conscious choice?
Age helped. I mean, I'd been investing in real estate because this was probably in my where was I? It was in my early 30s. It's actually my early 30s. And I started investing when I was 17. So I've been investing in single family residences for sort of through family and friends kind of casually for 10 years. So I had a certain amount of experience under my belt, although I was honestly scared, blank, blank, blank. when it was time to go from single family to multifamily, I'm like, I don't know what the frick I'm doing here.
Right.
But I worked as a teacher. I actually worked in special ed, and I worked in marketing and advertising. And so, I had a job. And so that allowed me to use my investing not for primarily and originally for cash flow. It allowed me to use it as a form of investing towards my future.
Yep.
So the job kept me safe for a while.
But yet you were able to make the successful transition, because I know there's a number of listening right now who would love to know, what was your super secret success formula to go from working, 40, 60, 80 hours or wherever it was on a weekly basis to setting yourself free by having this portfolio?
It was waiting until my portfolio was big enough to support me.
Oh God, you said waiting. No one wants to hear that word.
I waited. I'm sorry. You asked for the truth. I try to be very straight with people. I really do, because real estate is full of personal opinion. Personal opinion is okay if I share personal opinion?
By all means.
Okay. Real estate is full of the concept that you can do it overnight and it's easy, or it's like you can just grab it and ride that bull by the horns and it'll be a little bit bumpy, but you'll get there. And it's like, yeah, but ultimately money moves at the pace it moves. And I've seen people who are either very entrepreneurial and excited, and they really run out there and they grab the bull by the horns and they really do it. And sometimes they just get slammed. And I've seen entrepreneurs go out there and they grab the bull by the horns, but they're very careful with their numbers, conscious to their numbers. And honestly, I think it takes both. I think it takes get out there, grab the bull by the horns, get it done. I'm passionate about it. I think it's a field worth participating in. I've got no problem with that. But be aware that ultimately it really is a field about numbers as well as people.
Indeed.
And so waiting. I waited until my numbers worked. I did. I know it may not be popular, but I did.
No, you're not. We might have just lost a few people right there. They're like,
Sorry.
Waiting. I don't want to hear that.
I don't want to hear waiting.
Right.
But it was waiting until the cash flow worked. It was, for me, the single families just didn't bring me enough. It was when I moved into my first multi-unit that I had enough equity to roll forward in a 1031 exchange and looked at the cash flow of the building and blah, blah, blah. And that was when I went, I got it.
Yes, indeed. So here's something that you said that I know, because I'm guilty of the fire, aim, ready strategy more than I am the ready, aim, fire strategy. That's just me. And it does take both, but there's benefits and downsides to both. I'm curious though, from your vantage point, what is it that you see in your mind that prevents most people from actually taking that initial plunge? Because the individuals that I tend to work with, they're always like, how can I write that first offer? I don't know this, and I don't have this, and all these other things are missing. And I'm just curious as to how did you manage to tackle it? How do you walk people through that? Okay.
I managed to tackle it because I did it on a small level several times in a row by getting this house for my mom. And then I bought a condo for my brother. And then I bought another house for my mom. And I kind of walked through it one escrow at a time. But when you're given a house, you have to walk through it. Like, here you go. Here you go. It's yours. You have to take care of all the furniture and all the things in it. And you have to find a renter. And I'm like, crap. Okay. Let me work this out. So that was one. But really, I think the thing that stalls people, just because I think that was part of your question, is what makes some people move into it and some people don't. I think that stalls people is one of two things. They either don't have enough education/experience. And the reason why I say education/experience is because you can learn either way, either through experience or you can learn through education. And if you're lacking experience because you've never written the offer, then what's available to you is education, right? Because you only get the experience by writing the offer or by tailing along behind somebody. So education to me is a huge element in being able to get there. Now, obviously, you don't want paralysis through analysis. We're not saying that, but we're just saying, you want the education. The other thing is, I think people don't always know, and it might be an education thing for you because I know this is your specialty, but they don't feel like they have the cash they can start with. Usually, people who first want to get into real estate, I think 60 to 70% of the people who are attracted to real estate don't actually have assets or cash or equity to go buy with. Right. There's so much of it. So it's like, well, how do I figure out how to have a job in real estate? And right then you're really training yourself literally for an occupation. Right. And so I think some people get confused. They think, oh, I just want to buy a piece of real estate. That is how I get there. And it's like, no, I think actually you want career training, right? Which is what you offer, right? It's career training, right? How do you get people to know who you are? How do you network? How do you develop a product that you're going to sell? How do you support your clients? How do you support your investors? What is it? What is your inventory? Right? I mean, that's career training. So I think, personal opinion, either have equity you're starting with, or you understand you're going to train yourself in a career.
Yep. And it starts that way. And most people tend to choose, wholesaling or fixing and flipping, whatever those, strategies look like. But eventually you've got to make that transition, in my opinion, for sure, over to the cash flow side of things, because until you make that transition, you're just stuck. You just built a new job, and who wants another one of those things?
Yes, that's all you've done. You've built a new job. I mean, I sometimes get people who come into my practice who are flippers. And they're successful flippers, and they're great at flipping. And I mean, that high kudos for that. I'm sorry. I've done flipping. So I know how hard it can be to be a successful flipper, to do 10 flips a month or, 30 flips a year. So I have respect for that. But then it's like, I have to remind them, okay, that's not actually passive cash flow. Right. That's active cash flow that you're working really hard and doing a great job at developing, but you just have another job. So let's start allocating, quote unquote, assets or equity away from the business, because I have to first get them to wrap their mind around the business, away from the business, so that you can then buy something that brings you cash flow where you're not, what's the turn of phrase? While you're sleeping, it's writing you a check.
Right. We're bursting lots of hopes and bubbles right now.
I'm so sorry. You could call me an expert at that. I try to be. I'm really bullish on real estate. I really am. I'm very bullish on real estate because I think it's a field that ultimately, if you want, 80% of the world's wealth is held in real estate.
Say that again, because I want to make sure they heard that part.
80% of the world's wealth is held in real estate, and there's a reason why. And that is because real estate works for you whether you're sleeping or whether you're awake. And it's a commodity. It's an asset that holds intrinsic value to itself.
Woohoo! She said the key word, people. The key. If this was Sesame Street, the word of the day would be intrinsic value right now, because that's the thing. Because I fight this battle. Living in California, everyone's a fix and flip mindset. They're like, "Ooh, I just made 40 grand today." I'm like, "Awesome! You got to do it again tomorrow." Right. And I'm like, well, how can you do that on a monthly basis without having to get up? That's when you got my attention. And, especially during the summer, you got all these shows, fix and flip this and flap that, and it's everywhere. But the thing that, since we're on this bubble bursting, row right here, why don't we talk about a couple of the, largest mistakes you've either made or that you've seen people make, so, cause, everyone's like, oh yeah, it's probably, they seem to think it's easy now, right? It's easy for you today, right? Well, no, we're still human. Last I checked. So share with us a little bit about some of those, we'll call them learning lessons.
Learning lessons. Yes. Or in the case of my daughter, I call it practicing.
Right. Everyone's a practice, and I've always thought about that. Doctors get a practice, lawyers get a practice, but for some reason, we can't call it a real estate practice. That's not a common word yet, but I find it interesting. Anyway, yes. Share with us some of those practices, if you would.
All right, I'll share with you a practice. This one's one of my favorite because it's the one that taught me, one of the things that taught me about the profound necessity of due diligence and really knowing your numbers, even though
this is going to be good.
I have like a bachelor's in business, right? You would think, and I had been investing by 10 years already at that point. So, you would have thought that I wouldn't have fallen for this. Okay. So this is just like even the 10-year, the 10-year-olds, still fall and skin their knee. Okay. Okay.
But hold on. Isn't this, that's the truth of the matter is that's when the mistakes occur the most, at least for me, is when it's the ones you don't think you would make. You're like, I can't believe I did that. It's always that way. This is good. I'm taking notes. Go.
Okay. Yeah. Take notes. Okay. So, a friend of mine, who's an associate of mine, who was knowledgeable in real estate in California, was opening up a syndicated apartment rehab syndication in Texas.
Okay.
Right. And I thought, oh, great. This is somebody I kind of trust. They kind of belong to my community. So I have some, time with them, blah, 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 blah. Right. And so I went through and I looked and I was talking to him and he's like, oh yeah, 35% return, at least 35% return. I'm like, oh, that sounds great. Right. Sounds fantastic. And because he was my friend, I didn't, and I wasn't as diligent about my due diligence. I'm now, 15 years the wiser, or not quite 15 years. This was 2000 something. So maybe it's not quite 15 years, but I'm the wiser now. And so I went through and I didn't worry as much about getting the financials. He sent me some financials that had some IRR numbers on it. Mm-hmm. Right. And of course, we're all incredibly knowledgeable on what an IRR number is. And we all know how to calculate it in our sleep. Right.
You learn it when you need to.
Right. Now I know it. Right.
Right.
So I invested with him, and a year and a half later, it was like, oh, well, we needed $200,000 more in subflooring, and we didn't know we were going to have to redo all the subflooring. And we, property taxes, we didn't know they were going to be 2.65% in Texas instead of 1.25% in LA, and blah, 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 blah. And sure enough, by the time we were done, there was no cash flow coming off the building, and we ended up selling it at a loss for all of the assets that we had put into it, because he said 35% return. It was 35% return over 3 years. And if you take 35% and you divide it by 3, what do you get? Let's see, a little more than like 11 or 12.
Right.
And of course, with the $200,000 worth of flooring and the property taxes, and then this and the that, and the high vacancy rate in Texas, because this guy was knowledgeable in California.
Right.
He was not knowledgeable in Texas. He didn't know they had the high property taxes. He didn't know you had to actually go to court to get them lower. He didn't see the $200,000 worth of subflooring, and he didn't understand that 8% or 9% vacancy factor is normal in Texas. So there you go.
Yeah,
we didn't get our money back on that one at all.
No, well, you know what? I disagree. Here,
I got a huge education.
Exactly. And you leverage that education into many different ways now. Right. And that's the thing is understand, okay, especially for those of you listening, you're like, oh my God, I never want that to happen, so I'm not going to do real estate at all. That's the wrong decision. The decision here is, how do I take my learning lessons, my practices, and turn them into education that is beneficial, that is profitable. How do I leverage it? Blah, 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 etc. Yeah. And those are the things that I want to make sure that people understand, that's the key here. The key is to making sure that no matter what happens, learn from it. Even the successes, learn from it, because that's where the value is. No matter what actions you do take, the only wrong action, in my opinion, is inaction, because, that's you're not going to change and learn a whole lot in that particular instance. And now you've thrown out a number of terms. This is why I say words make you rich, is because you got to understand. I mean, some of you are probably like, okay, she said homestead, installment sales, syndicated, IRR, ROI, and she's talking about many different forms of ROI at that. Mm-hmm. And now you're just like, oh my God, I quit. Now,
don't quit. It's so don't quit.
At least not yet. But I want to talk about something, because this is something that I everyone in the marketplace faces, is they don't know the language of real estate, and they don't even know the questions to ask. Something as simple as when you heard, oh, it's got a 35% return. Until you don't think to ask, over what period of time? Because the traditional definition is over 12 months, and we tend to make an assumption, or at least the first 12 months. After that, it becomes a return on equity and all these other numbers. My question to you is, what would you consider to be some of the most basic words that many people need to know well ahead in advance of doing anything and making things happen for themselves?
Okay. So obviously, return on investment or return on equity. Like, how do you calculate that?
Right.
Let's just start with that. Because to me, that's the bottom line.
That's true.
It's okay, how do I do that? Now, here's the difficulty of me saying that. How you do that is different based upon the asset type.
Yeah.
Okay. So if it's a syndicated deal and they're going to send you a check because they're the expert doing all the business. So what I know about my return on my equity is that I get a preferred return, right? And then I get some share in equity, and I need to know the percentage, because one of the things I've noticed on syndicated deals is they say, oh yeah, we're going to get I call it the shiny object or the salesman approach, whatever you want to call it. You're going to get, we're going to get a 35%. I'll use 35. We're going to get a 35% return in the first year on this deal. And I go, great. Now, how much are you keeping of that, and how much do we get of that, and what percentage of the investor pool am I? Okay, so 35% investment, but you're going to keep 70% of it.
Right.
So that means I'm only getting a portion of the 35 is available to the investors, which is 15, and then I'm only getting 15%.
Right.
Of that 35%. So it's like, you got to watch for that. So that's why calculating your return on equity ends up being very important. Then how do you do it when it's a straight, you're going to buy a house and you're going to rent it out, and you've got your mortgage payment, your property tax, and your insurance and your maintenance. Yes, you have maintenance. Okay, don't forget.
No, my house is maintenance free. No,
of course,
it's never
all
gonna
houses
happen.
are maintenance free.
Yes.
Right, and then you use 50%. I use the 35% rule, but I know lots of people, especially if you're a young investor, who use the 50% rule. That 50% is going to go to your property tax, your insurance, and your maintenance and long-term care, and then what you have left is the other 50% for your mortgage and your profit.
Right.
So that's one. Another one is, I know lots of people love cap rate because my background's in multi-units, right? But cap rate can be hard for people to calculate, right? So I actually use the 1% rule, which is if it brings you 1% of its purchase price per month, then it's pretty good. So if it brings you $1,200 a month, it should cost $120,000.
I get it. Yeah, totally.
Right?
Totally.
1%.
Yeah.
It's pretty. I like using the raw ones. Like just give me the bottom line as quick as you can, so I can decide to invest my time in actually finding out the real number.
Right.
And the other one is the gross rent multiplier, because I do multi-units. So it's very much like the 1% rule, the gross rent multiplier. How many years is it going to take for this property to give me back the amount of money I put into it? Right? Is it going to take me 10 years? Is it going to take me 20 years? If you're buying in Santa Monica, it's 20. Don't buy in Santa Monica if you want cash flow. It's not going to happen.
Right.
And generally, you want 10 or lower. I mean, it's a rule of thumb. I mean, it's a really rough rule of thumb. So be careful. Just those are the type of things I encourage people to know. And then, of course, there's a lot of other things to know as well. But if you kind of understand your return on equity and how to get it, you understand what your cap rate or your gross rent multiplier, and you know the 1% rule, you're pretty safe. And you know how to read a syndicated contract, like what's my preferred return. And those are kind of basic, gross, like down and dirty. I can at least kind of half protect myself with those.
100% agreement in all of those things. It's funny how those are the words that we need to know, but they're never taught in kindergarten through 12th grade. But, I digress. So with that being said, one of the other terms that I just want to hear your opinion on is I'm of the opinion that one of these two is better than the other, and I'm just curious to hear what you say. Because many people talk about return on investment.
Right.
I like to try to focus on a return of investment. And of those two, which would you consider to be more important and why? All right, don't worry about it. I am going to tell you which of the two are more important. And she will tell you her two that are also important to her for her reasons. So, don't worry about that. Here's the point. We'll get you back to that in a second. I'm excited. Wanted to give you guys a quick update because we are making progress. Those of you, we are getting prepared for the 100th episode. I know you are probably doing a countdown somewhere. You got a calendar. I know you do. I know you've been thinking about it for a long time. No, you probably haven't at all. Anyway, as you know, I'm still working on the audiobook, almost done. I have a sneaky suspicion you will be hearing it soon, as in probably within less than 30 days from now. As far as I know, we'll see. But stay tuned for that. If you're not already on the list, 949-682-3565. Send a text message to that number, 949-682-3565, with the keyword is audio, or go to cashflowdiary.com/audio. One of the things that we're doing over here, I'm also making time. You guys hopefully are going to appreciate it. We're going to have some, if you listen to the show for a while, especially the beginning ones, there were a number of episodes where it was just me and you, just me and you, just me and you. We're going to get back to some more of that here in the not too distant future, because I've heard from you that some of you actually like that. So that's good. We're going to have some time to be able to make that happen. And I'm excited to do it. I've got so much that keeps happening, so much that is keep growing. And those of you who have been following us inside our founders membership, you understand all the things that are going on. But the good news is you've got things going on too, and I can hear it every time you guys send in an email, and I thank you for that. So just a small update to let you know I haven't forgotten about you. The audiobook is on the way. Stay tuned; it'll be there. Let's get back to the interview.
Okay, I actually, because I like cash flow, I actually prefer return on investment.
Okay.
I actually do. Return of investment is very, very useful if you want to make sure that you're going to actually, how do I put this in the right languaging? That you're going to actually recoup your capital, because you want to make sure you're going to build your capital over time. Mm-hmm. So return of your investment is all about recouping your capital over time. But I think if you're looking for a long-term stabilization, the down and dirty, the one I can go across all different forms of investing, right? A syndication deal that does give me my capital back, a syndication deal that doesn't, a fund that won't give me my capital back, but does give me cash flow, an apartment building that I'm going to hold on to for 20 years and sell later. Like all of that, I actually do return on investment.
That's awesome. And we've done a mixture of both. And I always like to find out which one people prefer. Mm-hmm. And, recently one of the things that we've gotten into doing is giving a return of the original principal, mm-hmm. and still letting investors maintain an equity interest as we go forward.
Okay. Now let me stop there.
Okay.
Let me tell you, listeners, that's freaking awesome. That's what you want. Okay. If somebody gives you that, then you run to the bank with that one.
No doubt.
Because it's like, yeah, absolutely. If I can get a return of my investment and continue to get cash flow as an equity position afterwards, I'm getting, what's it they always like to say in tax liens? I'm getting 1,000% return or more because I invested no money in it. Right. So, how can you calculate a return on no investment in there? It's unlimited. So I love those deals. When I see those deals come across my table, or I'm vetting it for a client or doing due diligence for a client, I go, these are good deals, because not only do you get a return on your investment, you get a return of your investment, and you get ongoing passive involvement after you've already officially finished the deal.
That's
rock with that.
That's the stuff that I love to talk about and I love to do. But the key for people to understand is that it takes time on the front end. That doesn't happen. Like, you don't do that that's not a 60, 90-day deal. We've got to develop an asset. It takes time, and it's usually going to be commercial in nature. It's really impossible to do with most single family houses. That's hard. It's easier, with an apartment building or a commercial structure or a resort or whatever it is that you're building. And I was just curious to how you viewed them, because I didn't know. I just didn't know. And I thought it would be interesting to find out. Yes. What would you say? You've been doing this for a while. Mm-hmm. Yeah. And if your career has been anything like mine, you've had those moments where you go, I think I should stop now because life is hard right this second, and you consider quitting. You may not actually quit, but you consider it.
Yes.
And so what has kept you going? Why still do it?
Oh, I love your question. That's such a great question. Because I think it is, I don't know, I'm not that old, but I'm old enough that every once in a while I'll get around some other old timers and we kind of, bat this question around.
Right.
Right? Like, why do you stay with it? Well, it's a good return. It's a pain in the backside sometimes.
Right.
I'll tell you a story. So it was in one of the, I've seen 2 full market downturns, and it was in one of these downturns. And I was, running around watching my assets lose money. Yes, assets lose money. California real estate goes down. Guys, do not be fooled. California real estate goes down. California is a practice of timing, considerate trend investing,
right?
Day trading,
right?
Right, is that kind of timing, or you can invest in the Midwest, which is anywhere between the 405 and New York.
Well said. Well said.
Okay, obviously that's not completely true. Maybe
Close
how about
from a price standpoint.
How about the Coachella Valley and New York?
Okay. Sure.
So I was in one of those moments, and I'm just going, I have totally hosed it. I don't know what I'm doing. I can't believe I put so much assets out there. I'm an idiot. I mean, it's just how I'm. Just to be very raw. I'm a bit raw. Sorry about that. That's how I felt. I'm an idiot. I don't know what I'm doing. Why would I ever consider myself to be a good investor in real estate? And I remember sitting in my chair in my office going, okay, Christina, you have a choice. You can either clean up the mess you have and continue to invest in real estate because you chose real estate to be your field, right? To be my passion, my expression as to how I'm going to operate in this world as well, right? And that's pretty core. Yep. I mean, I don't know about you, but it seemed pretty core to me at the time.
Yep.
Like, no, I either go back and get a job.
Oh, God.
Right?
Oh.
Or I stay with that I chose this as my act of freedom and my act of control in this world and my sense of like, this fit me. This is my nature. Mm-hmm. And I went, I'm not going to give up. I'm going to learn. I'm going to take this lesson really freaking hard, and I'm going to learn. And I'm going to trust that I learn. I'm going to trust myself as a being that I will learn from this instead of walking away from it.
Yeah.
So
you're speaking straight to my soul, because that's it. I say it this way. I just say real estate got me into this, and real estate's going to get me out. I don't know how, but that's okay. I don't need to know how. No. I just need to know that I'm willing and I'm committed to see it through. And that's been one of the things that I think, it's hard. That can be a challenging decision to make, is when you don't know the answer, to be committed to finding the answer no matter what it takes, even though you don't even know who to call. Yeah. Because I can remember the first time what happened. And because again, if you're a property holder, these things happen. So here we go again. The first time I had a tenant pass away, I was like, what do I do? Because rent was due. And in this particular case, it was worse because it was the tenant's child, not actually the tenant themselves. It was one of their children. And I was just like, okay, this stinks. Rent's due and the child has just passed away. Do I really want to deal with these types of things? Right. Is that, and I can remember the first time someone was late and it was near Christmas, and it was like, okay, it's near Christmas. Am I running a business, or do they get to stay for Christmas? It was all these decisions and moments. And I can remember the first time I had a building catch on fire. I'm like, oh my God, really?
I thought I had good stories. I've never had a building catch on fire. I thought I've had.
Really?
I thought I had some good stories. I've never had a building catch on fire.
What?
Yeah, I know. Isn't that amazing?
Yes.
Wow.
That makes no sense to me right there, because if that's I've had one building catch fire 3 times. It's just crazy. I'm just like, what? How did you have none? But okay, that's not fair. I got your share. Clearly.
You got my share. You clearly got my share. You really did.
But now that I've gone through all of those things, these are all things that I feel have built us into a bigger, better company, a bigger, better investors. We can make better decisions. I mean, we don't freak out. And I think And I'd love to hear what you'd have to say about this. I think one of the reasons that makes some promoters and syndicators successful is not because the investors know that, hey, everything's going to go well, but that they know and believe that, hey, when something happens, I believe that these guys know how to fix it, and they'll be at least able to go out there to protect the asset and still get back on track.
Okay, so you just hit a big thing for me. So is it okay if I
by all means, go for it.
Yeah.
Go for it.
Because I do a lot of due diligence on syndicated deals these days for my clients, and I do my own investing as well. And you heard my story about not really understanding the importance of due diligence on that deal in Texas, right? Okay, so I have a little bit of energy on this one, because honestly, when I do my due diligence, when I look at a syndicated deal, because really when you hand your money over in a syndicated deal, you're handing your money over. Like, let's get clear here. You're not gonna, say, knock, knock, knock. By the way, can you give that back to me tomorrow?
No.
Most of the time, that's not in. If you're lucky, you can get it back in 30 days. Okay. But really, you're just trusting them to run with it, especially in joint ventures. You're just trusting them to run with it. So what I look for when I actually do my due diligence is how accurate, because part of it is I have this experience behind me. How accurate do I feel like they are in their assumptions, like appreciation, rental appreciation, right? Vacancy factor in that market, right? Yes. And it's not because I expect them to go out and do all this research, although I sure hope they have. Right? That's not the only thing I'm looking for. The thing I'm looking for is what position are they coming from and how they're going to handle this investment and therefore handle me as an investor. Are they overly optimistic because they're young? Okay. Are they conservative because they've seen it before?
Yeah.
And so I'm really looking for I want them to know the numbers, but I'm really looking for who is this person I'm handing my Rolls Royce to?
Right.
Okay. Because I'm handing over $100, $200, $300, $400, $500,000 at a time to these people.
Yep.
So I'm handing them a very nice Porsche.
Yep.
Okay. Now, if you're, those people who drive up to the valet and say, it's a Porsche, don't park it by anything else. Okay.
Right.
I'm handing over a very nice asset to these people. I expect them to be capable of driving it. And I'm spending most of my time in the due diligence, making sure that they know what I can find out on the internet and they've handled that information appropriately. If they have, then most likely they can handle it when it goes wrong.
Yep.
It's not 100%. It's not A plus B equals C, but I have a much better understanding of, who am I dealing with? Because
you're speaking straight to the core, because I spend so much time. That's the thing is I spend so much time focused on building a team that can help me handle any possible contingency. And more importantly, and people laugh at me when I say things like this, but I consider myself a conservative guy. I do, because, and to give an example of what I mean is, I prefer, when I acquire a building, I prefer it vacant. Because that I don't inherit
you don't inherit any problems.
I got nobody's problem, and I can open up all the walls and I can see straight through the building. I feel comfortable. I'm like, yes.
Right.
And then people are like, how is that conservative? I'm like, you don't understand what happens when you inherit other people's
messes.
So yes.
At my Phoebe Pasadena meeting.
Yes.
I will often, probably once, we hold the meeting every month, right? And so probably once every couple of months, I'll stand in front of the room and go, okay, guys, I'm either the barest bull I know or the biggest bull bear that I know. I'm either one or the other, because I'm constantly excited about the possibilities that real estate brings me. But once it hits me, I'm like, oh, no, we're going to do our due diligence here.
Yeah.
I'm excited. I don't confuse this face. This face is completely excited. I just need to know where I'm going with this and where you're going with this. So let's have a real clear conversation, if we can, about what we're up to here, so that I can, it's the version of looking all the way through the house and going, I have clarity and I know what's coming at me. And if anything's coming at me that I don't see, it's not because I didn't look. I can trust myself that I've looked.
Right. And
right?
I got goosebumps over here. It's awesome because it's so key. Now, there's one more thing that I know that I'm going to have to deal with. Okay, that you've probably already seen, and I the only market I know has been this crazy chaos since 2008. I've never seen yet this super run up stuff. I don't know what that looks like. I have no idea. I've never used a bank for any of my financing.
That's good.
I've done everything, quote unquote, the hard way. Mm-hmm. So I'm curious to know, where do you see us in the marketplace and in general, and how do the rules change as things get better?
Oh my goodness gracious. How the rules change is a really big answer, but I want to give you at least some thoughts on that, because if you're going to invest in the LA market, you really want to understand that. Because the LA market, pick any of your major cities, LA, San Francisco, Chicago, Washington, D.C. I mean, to rent a penthouse in Manhattan, New York costs over $20,000 a month. $20,000 for your rent per month in New York. I don't know about you, but that floors me. I don't know. I'm thinking I can buy a down payment on a good Midwest home for that.
Yeah.
I'm just thinking that's a little intense for me. Yeah. Okay, but maybe I'm wrong. Maybe I don't understand New York living. I think right now, nationally, now this is very, because this is, obviously your show is a national, this is national or international.
Yep.
So let me be clear. I'm talking the United States, and I'm not talking regionally. I'm talking nationally. I think nationally, our real estate market is fine and healthy and will continue to appreciate for the next 3 to 5 years. Now, as Bruce Norris likes to remind me, he says it's not about timeline, Christina. It's about indicators. So don't stick to 3 to 5 years. Stick to indicators: affordability index, inventory, price changes, those basic indicators that we all want to follow with, right?
Yep.
So I think as of August 2014, got to put a state stamp on this. I apologize, but you asked me for where we are in the market. So I do all this on purpose. I really do. It's funny, and it's important. If you're an investor, you want to understand the effect of time. Yep. Where are you in the cycle? Okay. When the blood is running on the streets, if you actually have equity available, you want to invest if you feel that the market has come to some version of a bottom. And by the time you figure out it's the bottom, it's probably is the bottom or past the bottom. Right? So I'm not saying you're catching a falling knife. I'm not asking you to do that. I'm just saying when the money's, when everybody's scared, that's when you want to start paying attention.
Yep.
That's when you go, hey, there's an opportunity to invest. Ding, ding. The bell has rung. There's an opportunity to invest here. I need to observe. Okay. So that's when it gets your attention. As everybody's getting super excited and everybody's talking about how fantastic real estate is. And you have, in LA, there was four buyers to every one real estate agent in LA. Now, if you're a real estate agent, you can't live on 4 closes a year.
Wow.
Okay. You can't.
No.
And if you have 4 buyers, you're not going to close all of them.
Nope.
Okay. So you have, let's say this run up in gold and there's all these gold exchanges now.
Right.
That's when you start getting worried.
Yeah.
Okay. When everybody's super excited is when you start observing again and go, oh, I better watch my indicators every month because I'm going to get worried here. There's a time when I need to either sell everything I have, translate everything I have, or transmute it into a different style of investment, take it from LA, move it to the Midwest, take it from the Midwest, move it to LA, whatever your particular plan is. But be very careful because when you believe the rumors on the street, the exuberance on the street, I don't know about you, but that's when I've gotten slaughtered. I'm just talking personal experience, right? I'm just saying I've been there, and I've I can't lose money in California real estate. Yes, you can. Can't lose. Hawaii is a great place to invest. It always has a tourism industry. No, it doesn't. Knoxville, Tennessee has always got its university. You're never going to lose renters. Yes, you do. I've done it across the United States, and every city has its story. Be careful.
Right. Oh, okay. I love it. It's, you know what? It sounds like a lot of work. That's what I hear. There's still work involved because oftentimes we're sold this bill of goods or we say things like, hey, it's passive income, but somehow we try to make that mean we're uninvolved.
No, you don't want to be uninvolved. That's really dangerous.
Yeah, I got stories too. I can hear in your voice you got at least one.
At least one.
Right.
No, do you want me to run with that? Or?
Yeah, by all means. By
Okay.
all means.
Okay.
By all means.
When you first develop your portfolio, when you're first becoming a real estate investor, I can't jump up and down and say it loudly enough. Education, 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 education.
Say it one more time.
Did I say education?
Yes.
Did I mention education?
You might have mentioned it.
I might have mentioned it.
Right.
And there are lots and lots and lots of workshops out there. Some of them inexpensive, some of them very expensive. Don't need to take the super expensive one. Takes a whole slew of inexpensive ones. Slew upon slew of and study with lots of different people.
Yeah.
And then you'll finally find your place in real estate. And then monitor. And I don't actually currently own any direct ownership. I switched over because of my lifestyle choice. I'm a mom now. Yeah. I switched over to all passive investing, hard money.
Okay? Oh wow!
Cool. So yeah, it's great because I have that choice. Lovely, right? So, but when I actually had direct ownership, I basically set up a system where I paid attention to each building about 2 hours a week. Does that seem hard, or does that seem like maybe it was kind of easy?
Well, it takes discipline, and that's
right.
That's the key.
It was only 2 hours a week, right? And it was a building because I owned multi-units primarily. I mean, sure, I had other investments, syndicated deals, investments in small businesses, those type of equity share investments, joint ventures, and stuff like that. So I had active investments that took the rest of my time because I'm a full-time investor. Now I'm an investor and a coach and a mom, with my consulting practice and my daughter. But each building I had down to basically 2 hours a week. And it ran great on 2 hours a week. It really did, because I'm looking at 18 units, 30 units or so, 2 hours for managing 30 units a week, for contacting write my email on Monday, look for the reply on Wednesday, do shadow books behind them so I know what they're spending and it works inside the cash flow, give a little bit of direction back on Wednesday evening. It's not too hard. Once you get it, once you invest the upfront time and the energy and the education, it really can be very supportive and very free. But you want to invest the time early so you're not having to reinvest the time halfway through.
Yeah, and getting it done right once the first time is so less expensive. Been there, done that one. Been there, done that one. That's for sure. So let me ask this question. I get the feeling you and I could talk. We've got stories.
Yeah, we could talk a long time.
Yeah. But for those who are like, okay, how can I find out just more of Christina? She's so awesome. What is it that you would want us to do? How do we get more of you?
Okay. Very simply, for the Massey listeners, for those people who have chosen to sign on, I'd like to give a free gift because I really like to reward people for reaching out and learning about real estate. And if they're listening to your podcast, they've invested the time to learn. They've invested the time in the beginnings of their education. And I am serious about my commitment to that. That's why I run my Phoebe group the way that I do. I'm serious about people getting educated at a nice price point so they can be prepared. So the point is, call me. I will happily give you 30 minutes of my time to either listen to your problems in real estate, answer any questions, and give you whatever works for you in that 30 minutes. My time is available to you. So here's my phone number, straight up, 310-463-5942. 310-463-5942. That is my direct cell phone. You will get me. Okay, guys? I am so available to you. Now, if you want to check out more about who this crazy lady is before you call me, because I am a little bit of a crazy lady after 25 years of doing this.
No doubt.
groundlevel-consulting.com. Ground level, like real ground level, build it right from the ground, from the beginning. groundlevel-consulting.com.
Nice. Now, what would you say to that person who's on the fence right now going, I want to be one of these new superheroes. I want to get my cape on and become this entrepreneur. I would love to begin building my cash flow using real estate. If you had one last thing to say to them, what would it be?
Do it. It's really straightforward.
I love it.
Do it. Just do it. We are so in the right timing in the market to just step into it. You've got 3 years to learn. You've got the opportunity to step in. You have so much education around you, whether it's on the internet, whether it's a Phoebe meeting, whether it's an actual course. There's so much available. I hate to steal from Nike, but just do it. Just start engaging yourself, because right now there's actually a pretty good cushion of time to step in as a new investor and have an opportunity to kind of get your chops up before the market starts moving on you too much.
Yep, totally love
Personal opinion.
No, I'm with you. That's for sure. I'm with you. That's for sure. I definitely want to thank you for investing time here with us today.
My pleasure.
All right, ladies and gentlemen, you know what it's time to do. It's time for you to move at the speed of instruction. Now, let me say this. Don't all of you call her at once, but do call her if you know you are that person, that you're ready to actually make something happen. If you want to find out more information, go over to the groundlevel-consulting.com, because that's a simple way you can begin taking action and fulfilling the wishes, the desires, the destiny that is there for you. Because nothing is going to change until something changes, primarily you. And I'm looking forward to hearing all the great stories so that you can have them too, about your property investing and you out there building cash flow. It's been fun talking to you again. I look forward to talking to all you guys again soon. Until next time.
Thank you for investing your time with Jay Massey and the Cash Flow Diary. When you have a moment, please visit iTunes and leave a positive comment about the show. And go now to our website, cashflowdiary.com, to take advantage of our free business building course, Cashflow Foundation. Gain the knowledge, understanding, and skill that will teach you how to never need a job again. Until next time.